Welcome to another episode of The Green Bottom Line. Today, we're embarking on a deep dive into something incredibly vital for our planet's future: the rapidly transforming international climate finance landscape. Specifically, we're going to unpack the BRICS framework, focusing on a really critical document, the technical note on enhancing financing for climate action. This came out under Brazil's 2025 presidency. And look, this isn't just about abstract numbers. It's about mobilizing at least, get this, USD 1.3 trillion per year by 2035 for developing countries. That's a truly ambitious goal. Outlined in the Baku to Belém Roadmap, we're here today to try and help you make sense of this massive undertaking.
It is an immense challenge, you're right, and you've hit on the core of it. While the international climate finance landscape is, yes, undoubtedly undergoing accelerated transformation, it's vital to understand that emerging economies, particularly BRICS members, still face, well, significant hurdles. We're talking about persistent difficulties in accessing concessional finance that's essentially aid or loans with very favorable terms, and also mobilizing sufficient private investment and, crucially, aligning financial flows with their specific national climate and development priorities. So this BRICS framework, it offers a valuable space for dialogue, for cooperation, to directly address these long-standing issues, and hopefully pave the way for more effective, equitable climate action.
Okay, right. Let's unpack this a bit then. Before we dive into the solutions this framework proposes,
Yeah.
what are the fundamental challenges? What's preventing global climate finance from really tackling the crisis effectively, especially for emerging markets? Because, clearly something isn't working as efficiently as it needs to be.
That's the critical starting point, absolutely. The BRICS framework identifies four key areas of structural barriers holding us back. First, we have access and availability constraints, that concessional finance I mentioned. It's limited, it's fragmented, and it's notoriously difficult to access. This is particularly acute for areas like adaptation, helping countries adjust to climate impacts and also early-stage project development, and ensuring a just transition. That means moving away from fossil fuels in a way that's fair to workers and communities.
So even when there's money potentially available, it's like navigating a bureaucratic maze just to actually get your hands on it. It sounds incredibly frustrating. Can you maybe paint a picture for us? What does that maze actually look like on the ground? For a developing country trying to access these funds, are we talking mounds of paperwork, conflicting deadlines, or something else?
It's often all of the above, yeah. Combined with a lack of transparency and, frankly, an uneven playing field. And this leads directly to the second barrier: private sector barriers. Despite this enormous pool of global private finance out there, only a tiny, tiny fraction of it actually makes its way to emerging markets for climate action. There's just a huge disconnect, often because of perceived risks. Third, we face institutional limitations. The current arrangements of multilateral development banks, MDBs, big institutions like the World Bank or regional development banks, they simply limit their capacity to meet the scale of climate neologies. They're often not agile enough for the rapid, large-scale deployment needed.
So even these massive financial institutions aren't fully equipped for the urgency and the scale of the climate crisis. Okay. And what's the fourth barrier?
The fourth is regulatory fragmentation. Basically, the absence of clear, standardized, and harmonized regulations across different countries and regions. It leads to massive inefficiencies and significant market fragmentation. This just makes it harder for investors to navigate and scale up climate investments. But there's a really critical sort of underlying issue that amplifies all of these barriers: credit rating bias. This is quite insidious, actually. Credit rating agencies systematically assign lower ratings to developing countries. Imagine, a brilliant solar project in a developing nation, a clear win for the climate, right? Now imagine that project is essentially penalized before it even begins because of the country's credit rating. It makes funding astronomically expensive. It's not just some abstract financial metric. It's a concrete barrier that chokes off vital green investment. It forces nations to pay this sort of poverty premium on climate action.
Wow, okay, that credit rating bias is a huge piece of the puzzle I hadn't fully considered. So it essentially means even if a project itself is fantastic, maybe low risk on its own merits, the country's perceived credit risk could effectively penalize it anyway. That's a massive hurdle. How does this framework realistically propose to tackle something so deeply ingrained in the global financial system? This sounds like where it gets really interesting, as you said. The BRICS framework aims to provide a concrete pathway toward that ambitious USD 1.3 trillion annual target by 2035 through a comprehensive five-pillar approach. Let's start with the first pillar.
You've hit on precisely why this framework is so important. It attempts to address these systemic issues head-on. So Pillar 1 focuses on reforming multilateral development banks, MDBs. They are central because, well, they possess the mandate, the technical expertise, and the financial heft to mobilize significant resources for climate mitigation, adaptation, and a just transition. They can offer competitive financing, and crucially, they can de-risk private investments. The problem is their current institutional arrangements. They limit their capacity to meet the sheer scale of the challenge in emerging markets.
Okay, so they're essential players, but they need a serious upgrade, a rethink maybe. What are the specific proposals for these MDBs then?
Well, first, it's about untangling the red tape, really revamping their operational efficiency and governance. Think about simplifying procedures, yeah. Strengthening support for climate-aligned projects, and importantly, setting quantitative targets for private capital mobilization. Get specific about it. This also means establishing highly concessional windows, essentially grants and very low-interest loans, specifically for low-income countries, to mitigate their debt risks.
That sounds like a fundamental shift towards more direct impact and maybe some debt relief focus.
Right.
Making it easier for countries to actually take on these climate projects without just piling on unsustainable debt.
Exactly, that's the idea. But it's not just about speed, it's also about smarter tools, which leads to the second key area, promoting innovative financial instruments. This includes expanding the use of specialized bonds like sustainable, green, blue, biodiversity, and transition bonds. These allow investors to put their money directly into projects with specific environmental or social benefits. It also includes using guarantees and local currency tools to reduce those tricky foreign exchange risks. Third, there's a strong push for enhanced collaboration across institutions to build robust project pipelines, making sure there are enough investable projects that actually align with climate goals, not just a scattered few. And, as highlighted in the G20 MDB Roadmap for 2024, MDBs can dramatically boost their lending capacity, potentially without needing vast amounts of new taxpayer money. By smartly using things like callable capital, that's money member countries, have pledged but not yet paid in, and by optimizing their balance sheets, using innovative tools like hybrid capital or portfolio guarantees. Think of hybrid capital as a mix of debt and equity that frees up their existing funds, or portfolio guarantees as a way to spread risk, allowing them to back more projects.
Ah, clever financial engineering, essentially.
You could say that these financial levers are crucial to getting more money out the door faster. And lastly, reforms to governance structures are crucial, aiming for fairer representation of emerging economies and more flexibility in those climate-related mandates. This helps ensure MDBs are truly responsive to the needs of the countries they serve.
Okay, moving on to Pillar 2. We talked about how concessional finance is limited and hard to get. So what specifically needs to change there to bridge this investment gap and make sure vulnerable countries get the support they need to adapt and build resilience?
Yeah, this is a critical area because concessional finance plays this unique role, right? De-risking and enabling projects that might otherwise just be unfeasible. The framework emphasizes fostering scale, coherence, and effectiveness of global climate finance. This means prioritizing concessional adaptation finance for the most vulnerable countries and supporting those transformative projects that align with just transitions goals. It's about creating predictable, low-cost credit lines with extended tenors, meaning longer repayment periods for resilience projects. Especially for adaptation and loss and damage, we really need to move beyond these fragmented short-term approaches that just don't address the long-term nature of climate impacts.
Right, so less of a piecemeal approach, more long-term strategic funding. Funding that's actually accessible and designed for the unique needs of vulnerable nations. Makes sense.
Precisely. And the framework also addresses these vertical climate and environmental funds, VCEFs, like the Green Climate Fund. It proposes increasing finance mobilization through VCEFs by expanding risk mitigation instruments and developing more market-based approaches to attract private capital. A key innovation here is about mitigating co-financing frictions, between VCEFs, MDBs, and public development banks, using things like shared guarantee mechanisms and first loss capital structures.
So making it easier for them to work together on projects.
Exactly. It prevents existing resources from being underutilized just because of bureaucratic hurdles between the different funds, makes collaboration smoother. Additionally, there's a strong push for an integrated country-driven approach, which basically means enhancing national ownership through strong focal points, country platforms, and ensuring alignment with nationally determined contributions, or NDCs. Those are each country's climate action plans under the Paris Agreement, and their long-term strategies. It's about empowering countries to lead their own climate investment agendas. Finally, the framework stresses enhancing individual fund access and efficiency, streamlining approval and reporting processes, increasing disbursement speed, improving regional presence and project monitoring. The goal is to make these funds genuinely user-friendly and effective on the ground.
Okay, interesting. So beyond these international funds, Pillar 3 shifts the focus. It's about strengthening climate action on the ground, within countries themselves. What exactly are country platforms in this context, and why are they so important?
Right, country platforms. They're essentially voluntary and flexible mechanisms, increasingly used to align international support with national climate strategies. Think of them as coordination hubs, maybe. They improve policy coherence and increase the visibility of project pipelines within a country, making it clearer what needs funding. And it's important to clarify, they should not be seen as a prerequisite for accessing finance, but more as a facilitative tool. To really function well, though, they need clear governance structures and good coordination across various ministries and stakeholders within the country.
Got it. So they help organize and streamline efforts within a country rather than dictating how a country must receive funds. What else is needed domestically, then, to make sure these platforms and the broader climate efforts can actually succeed?
Absolutely. Well, the framework stresses the importance of a strong domestic foundation. That means allowing fiscal space for public policy implementation and ensuring sustainable public debt levels. These are really foundational for economic resilience and being able to implement climate policies. Beyond that, there's a clear call for developing a comprehensive national climate finance ecosystem. This involves creating appropriate domestic regulations, methodologies, taxonomies, those classifications for what counts as green verification mechanisms, government incentives, and other tools necessary to stimulate a country-led investment push. Crucially, this pillar emphasizes boosting domestic capacity. This means strengthening institutional capacity through targeted training, focusing on enhancing fiscal space, developing domestic capital markets, and strengthening national and subnational financial institutions. It also specifically mentions actively engaging national development banks in project pipelines, getting them involved. Finally, the framework highlights leveraging technology, using tools like AI and blockchain maybe to assess risks, track impacts, and ensure resource traceability, which is vital for transparency. And it also notes the importance of making full use of IMF concessional resources and capacity building to support macroeconomic stability and climate-aligned fiscal policies.
Okay, Pillar 4. This one tackles a huge challenge head-on, getting private capital into emerging markets for climate action. This has historically been incredibly difficult, hasn't it? Especially with that credit rating bias we discussed earlier. What innovative solutions are being proposed here to, well, de-risk these investments and truly unlock private finance?
Yes, this is indeed where a major bottleneck lies. The framework proposes a multi-pronged approach here. First, it focuses on revamping risk mitigation mechanisms. This means strengthening risk-sharing models offered by development finance institutions, or DFIs. We're talking about blended finance mixing public and private funds first loss and catalytic capital, which absorb initial losses to make projects more attractive to private investors, and multilateral guarantee platforms. It also advocates for expanding currency hedging and local currency financing options and exploring political and other risk insurance products, all aimed at significantly reducing barriers for investors in emerging markets.
So it's about making these investments less scary, essentially, for private players. By absorbing some of the initial risks, maybe building a kind of financial shock absorber.
Exactly, that's a good way to put it. The framework also pushes for advancing innovative financial instruments, broadening the availability of sustainable and green bonds, sure, but also developing specialized insurance products to support investment in high-risk regions. Third, it emphasizes leveraging public-private partnerships, or PPPs. The idea here is to encourage PPPs to co-finance large-scale climate infrastructure and support early-stage project design to make them more bankable, more attractive to financiers. But it's critical, the framework notes, to incorporate transparency clauses, safeguard against greenwashing, and adopt a just transition lens in these partnerships to ensure the creation of green jobs. And finally, there's a really interesting and specific proposal: championing the Tropical Forest Forever Facility, or TFF. This is envisioned as a long-term mechanism to mobilize private and international capital specifically for tropical rainforest conservation and restoration, recognizing the vital role these ecosystems play in global climate stability.
Ah, interesting. So a very targeted approach.
Yes, it's a targeted approach to a very specific high-impact area, moving beyond a sort of one-size-fits-all solution.
Okay, so we've covered MDBs, access, country capacity, private sector. So what does this all mean for the rules and regulations, the actual nuts and bolts that govern how money flows for climate action? Pillar 5 is all about strengthening these regulatory frameworks.
You've hit on a crucial point there. Robust regulatory frameworks are absolutely critical for ensuring that financial flows genuinely align with climate goals. Without them, well, we face inefficiencies, market fragmentation, and a huge risk of greenwashing, where investments are marketed as environmentally friendly, but, well, they aren't really. The goal is to create a level playing field, ensuring financial resources can flow to developing countries for long-term climate projects without additional barriers or excessive capital costs.
Right. And how do they propose achieving this? What are the key areas of regulatory reform mentioned?
The framework outlines several priorities. First, streamlining regulatory processes and reducing complexity. This involves enhancing transparency, reducing administrative hurdles, and aligning cross-border regulatory requirements to minimize transaction costs. Make it easier to invest across borders. It also means integrating forward-looking climate risk assessments into prudential frameworks like Basel III, those international banking regulations, and harmonizing ESG disclosures, environmental, social, and governance. Plus, establishing climate risk stress testing frameworks and financial benchmarks, crucially, without undermining central banks' autonomy. And, as we discussed before, reforming credit rating methodologies and implementing regulatory oversight to prevent greenwashing are paramount. Second, there's a strong focus on advancing carbon market frameworks. This includes supporting efforts to enhance alignment and interoperability of carbon market systems, potentially through initiatives like a BRICS carbon markets partnership, perhaps. It also emphasizes strengthening multilateral coordination on Article 6 of the Paris Agreement, which deals with international carbon markets, and highlighting the role of carbon markets in mobilizing finance for emerging market and developing economies, EMDEs. Capacity building and technology transfer are also vital here to ensure effective participation for developing countries. And third, the framework calls for expanding and operationalizing sustainable taxonomies. This means improving national taxonomies by referencing best international practices to facilitate cross-border investment flows and mobilize sustainable capital at scale, promoting interoperability between these taxonomies voluntarily. These taxonomies provide those clear, standardized definitions of what counts as green or sustainable, which is just essential for guiding investment and preventing greenwashing.
Wow. Okay, this is a truly comprehensive vision. I mean, it covers everything from MDB reform to on-the-ground capacity building and these sweeping regulatory shifts. So what's the timeline look like for all this? And what is the broader role of BRICS in these global efforts? How quickly can we realistically expect to see these changes unfold?
Well, it's definitely not an overnight fix. The framework envisages a phased implementation approach spanning the next decade or so. Short-term priorities, say for 2025-2027, focus on things like MWB operational efficiency improvements, initial regulatory harmonization initiatives, and establishing those country platforms. Then, medium-term objectives for 2027-2030 will emphasize scaling up private sector mobilization, expanding concessional finance, and integrating carbon markets more effectively. The long-term vision, running from 2030 to 2035, centers on full framework implementation, ultimately aiming to achieve that ambitious USD 1.3 trillion annual target and, well, comprehensive climate finance transformation. And this timeline is carefully aligned with the Paris Agreement's objectives and the UN's 2030 Agenda for Sustainable Development.
Okay, so it's a marathon, not a sprint, as they say, but with clear milestones along the way. And how does BRICS position itself in all this? Are they acting as a new negotiating bloc, or is their role more collaborative?
That's a really important distinction. The framework explicitly states that BRICS is positioned as a platform for dialogue and collaboration, not a negotiating bloc. It reinforces the critical role of South-South cooperation, where developing nations work together. The member countries share a commitment, it seems, to enhancing access to finance, strengthening country platforms, mobilizing private sector participation, and improving the regulatory environment. Importantly, this initiative seeks to contribute to broader international discussions on climate finance, particularly ahead of COP30 in Belém, Brazil, ensuring harmonization with ongoing G20 and UN FCCC initiatives to maximize synergies and avoid, duplicating efforts. However, it's also crucial to acknowledge the significant implementation challenges. Let's be realistic. The sheer scale of transformation required across multiple institutions and jurisdictions, it presents immense coordination complexities. The voluntary nature of many proposed mechanisms might limit their effectiveness if they aren't widely adopted. And as we've discussed quite a bit, the framework's success heavily depends on effectively addressing that systemic credit rating bias against developing countries. which requires engagement with international rating agencies, a tough nut to crack. Building domestic capacity and institutional frameworks will also require sustained commitment and resources over extended periods. This definitely raises an important question, doesn't it? How will these ambitious goals truly translate into concrete, on-the-ground actions, and what will be the biggest hurdle to overcome in practice?
Indeed. Still, this BRICS climate finance framework truly represents a significant contribution to global efforts to scale up climate finance. No doubt about that. Its comprehensive five-pillar approach directly addresses those systemic barriers we talked about, and it proposes practical, actionable solutions that could fundamentally transform the climate finance landscape. It seems like a blueprint built on country ownership, South-South cooperation, and these innovative financial instruments, offering at least a pathway towards achieving that critical USD 1.3 trillion annual target by 2035.
And what's fascinating here, I think, is that knowledge is most valuable when it's understood and applied, right? This framework isn't just theory, it's a proposed path for some pretty profound financial shifts. Shifts that could redefine how global climate action is funded and implemented going forward.
Absolutely. Which leaves us something to think about. As global efforts to tackle climate change intensify, how might these ambitious financial transformations not just reshape international markets, but also influence the daily choices, economic realities for countries and communities worldwide? What does a just and equitable climate transition truly mean for the future of investment? Thank you for joining us on this deep dive.